The Bank of England is making a big mistake. For the first time in its history, it's going through a process called quantitative tightening. It bought about £1 trillion worth of UK government debt, and now it has to get rid of it. Unfortunately, it's chosen to speed up the process by selling those bonds rather than waiting until they mature. In this video, I'll look at the consequences of that and also why I think it's a big mistake. Now remember, if you do like our content, please do subscribe to our channel and like this video. So let's look at why quantitative tightening by the Bank of England is a big mistake in a bit more detail. Now, what landed the Bank of England with so much debt in the first place was quantitative easing. Now, this was a new tool in central bank toolkits. It hadn't really been used before in the past. What was typically done in conventional policy was to change interest rates. So when economic growth is weak, the central bank cuts interest rates. That stimulates the economy because the cost of borrowing is lower both for households and for companies. And then when things return to normal, the central bank would raise interest rates again to normal rates. However, central banks thought this wasn't a sufficiently strong stimulus, just to lower interest rates, and so they decided to launch unconventional policy measures, particularly quantitative easing. So the central bank sets the short end of the yield curve. That's for borrowing over very short periods of time. However, if the bank wants to reduce the cost of borrowing for longer periods of time, then it can buy government bonds further out on the curve. And by reducing the risk-free rate at longer maturities, that also makes it cheaper for companies to borrow for longer periods of time. So conventional policy controls the short end of the curve, and quantitative easing supposedly reduced rates at the longer end of the curve as well. How does it do that? Well, it does it by buying government bonds. It pushes up the price of those bonds, and that pushes down the yield because the two move in opposite directions. That reduces long-term interest rates, both for the government, but also for companies. However, then when things return to normal, there's a problem. How do you get rid of that mountain of debt on the central bank's balance sheet? One way to do it is to sell government bonds. Now, as the central bank buys those assets, those government bonds, it's financing them with central bank reserves. And of course, its borrowing rate during this period of quantitative easing was very low. It set those rates itself. And that meant that it had a kind of net interest which was greater on the gilts that it bought than it was for the funding cost on its bank rate. So this sounds like a money printing machine. Of course, that wasn't the purpose of quantitative easing. It was to stimulate the economy. But the overall result of that, which you can see in this graph of the size of the Bank of England's balance sheet, is that it ballooned. It went from something that was pretty tiny to about £1 trillion. Now, if we focus just on the assets held in the asset purchase facility, which is what the bucket was called to hold its quantitative easing purchases, the size of that was pretty spectacular. It peaked at around £900 billion. But as you can see, it started to shrink since its peak. But at that peak, the Bank of England owned about a third of the outstanding debt issued by the UK government, which seems pretty weird. The government issues debts to pay for running the government, and then its own bank, the central bank, buys back that debt with made-up money. What's even stranger is that the Bank of England made a lot of money with that trade. It's estimated that between 2009 and 2021, the overall profit that was booked was something like £124 billion. Now, there's an agreement between the Bank of England and the UK Treasury such that the Treasury indemnifies any profits or losses generated through quantitative easing. So during this period, it meant big profits for the UK Treasury, and no one was complaining. But you can probably guess what happened next, and that was the process of quantitative tightening. Now, you've got two choices as to how you shrink the size of your holdings. The one which is least disruptive for the bond market is called runoff. You just wait until the bonds mature and your balance sheet shrinks. That's the beauty of bonds. You never have to sell them. You just wait some time until you reach the maturity date and you get your money back. At that point, the bond just disappears. Now, that doesn't disrupt the market, importantly. The other way to do it is, instead of waiting around for the bonds to mature, you speed things up, and you do that by selling the bonds. The drawback with that is that if interest rates have increased since you bought the bond, you could be facing losses. Waiting to maturity, you always get 100 back. If you sell the bond before it matures, you might have to sell at a depressed price. Furthermore, if you're the central bank and you own a third of all of the UK government bonds, then dumping those onto the market in one go would simply crash the market. So you have to be very careful and sell things very gradually not to do that. So how have other central banks gone about this? Well, the Federal Reserve, the US central bank, has very much gone down the route of runoff. As they set out in their plans for quantitative tightening, they said the committee intends to reduce the Federal Reserve's security holdings over time in a predictable manner, i.e., we're not going to shock the market by dumping our treasuries. So what they do is they look at how many bonds have matured over the previous month, say, and they allow a certain amount of money to leak out of their holdings. For mortgage-backed securities, that's $35 billion a month. For US Treasuries, it's $60 billion a month. So that means that their balance sheet will gradually shrink at a rate of about $95 billion a month. Notice that there are no bond sales here at all. They just wait for the bonds to mature. The Bank of England, on the other hand, has decided to go down the route of bond sales, as well as letting the bonds mature. So in February 2022, the Monetary Policy Committee decided that it wouldn't reinvest any principal that it got back from maturing bonds or any coupons either. Then in September of 2022, it announced that it would actually start shrinking the size of its balance sheet faster by selling bonds. Not only that, but it set a target for how much it would shrink the balance sheet at £80 billion per year, such that over the next 12 months, the size of its holdings would fall to around £760 billion. Then in November of 2022, the auction started and it started selling its holdings of bonds. Now, obviously, it didn't feel that this was disrupting the market because in September of this year, the Monetary Policy Committee announced that it would accelerate its rate of shrinkage of its balance sheet to 100 billion per year, such that in a year's time, the size of its holdings should be around 660 billion pounds. If we look at a letter that was written by Andrew Bailey, the Bank of England governor, to the Chancellor of the Exchequer, which is Jeremy Hunt, you can see some of the thinking behind this. The MPC's approach to these decisions reflected its intention to reduce the size of its holdings in a gradual and predictable manner, so as to avoid disrupting the functioning of financial markets. We're not going to dump them all in one go and crash the gilt market, is what the Bank of England's saying. Now remember, as gilt prices fall, you can lock in those yields by holding to maturity. So if you want to learn more about that, many of our pension crafters are buying single gilts, then you can do that as part of our community. Plus you get access to lots of other goodies, members only videos, and our chat application so you can ask a question whenever you like. And you get our trackers so you can have a snapshot of the UK yield curve. If you want to learn more about that, just go to our website, PensionCraft.com, and there'll be a special discount for members of the MPC. So why did the Bank of England decide to go down the sale route as well as the runoff route? Well, one thing is that the UK government tends to issue long-dated debt. It's done that for a very long time. Whereas if you look at the US Treasury, it tends to issue much more short-term debt than the UK does. So just by randomly choosing bonds to buy, in the UK on average, those will have a much longer maturity date. So what you can see beside me here are the maturity dates of the bond purchases for the Bank of England. That's in the top panel. Then in the bottom panel, we've got the same thing for the Federal Reserve. Notice how the US has many more bonds at the very short maturity dates, whereas for the UK bonds, they go all the way out to 2071 for the longest dated holding. The US has hardly anything maturing beyond 2050. What that means in practice is that if you rely on runoff, wait till the bonds to mature, for the UK you'll be waiting a lot longer. So here I've shown what would happen if the Bank of England just did runoff, and that's the yellow line, versus the Federal Reserve, and that's the blue line. So what proportion of its initial bond holdings are going to still be there after 1 year, 2 years, 3 years? One way to think about this is to look at the half-life of the balance sheet. Now, I'm a physicist, I won't apologise for using that number, but it's just the time taken for the holdings to halve in size. Now, for the Federal Reserve, that half-life is just over 4 years, whereas for the Bank of England, it's double that. It's about 8 years. So runoff for the Bank of England would take a very long time. Presumably, this is why it's chosen to sell its bonds, to speed up that process. However, it's been very aggressive about it if we compare it to, say, the European Central Bank, but also the Fed. Compared to their peak holdings, those two banks are only down by around less than 5%, whereas the Bank of England has shrunk its balance sheet by much more, by around 7% already, and it's shrinking it more rapidly. So you're probably thinking, well, why not? They want to get rid of these bonds, why not sell them? The problem is losses, and these come in two forms. The first one is interest, and the Bank of England has no control over this. It sets the bank rate, the policy rate, and that's currently 5.25%, and that's the rate at which it borrows money to fund its asset purchase facility. Then it receives income from its assets in the APF. Unfortunately, the income on those bonds is now less than its funding cost. So that means it's making an interest loss now compared to the massive profit it made in the past, when interest rates were low for borrowing, but the income on the gilts was much higher. The second source of losses is valuation losses. If you buy at a certain price, interest rates increase, then the price will fall and you sell at a depressed price. And the difference between those two has to be covered by the Treasury, by us, either in the form of taxes or through issuing more gilts. Now those losses only crystallise when the gilts are sold, and then that cost is passed on to the UK Treasury. And guess what's been happening to the UK yield curve recently? Yes, it's increased. And that's at the long end of the curve, which is the most painful because that's where the duration of the holdings in the APF are greatest. Now remember that for a bond, its duration determines how sensitive it is to interest rates. Really long dated bonds, like the 2071 bond, which is held by the Bank of England, that's very sensitive to interest rates. So a 1 percentage point increase in interest rates means a big percentage loss on that bond. So what I've shown here on the bottom panel is the size of the loss on each of the UK government bonds if those interest rates increase by 1 percentage point across the whole yield curve. And the loss approximately is about 20 billion across the entire holdings for every 1 percentage point increase. But notice how the losses are greater for the longer duration bonds than they are for the shorter duration bonds, simply because of the way bond maths works. So now let me ask you a question. If you were the Bank of England, which of these two bonds would you sell? You can either sell a bond from the short end of the curve, which matures in 2026 in about 3 years' time. There you'd crystallise a loss of 5%. Or you can sell a bond which matures in 2071, and there you're going to crystallise a loss of over 65%. So would you like a small loss or a large loss? And yet, the Bank of England chooses to sell everything, including those long duration bonds, which is an interesting choice. But that choice has bad consequences. The obvious bad consequence is losses which are then passed on to the UK Treasury, and that's via the Asset Purchase Facility's Treasury indemnity. How is the Treasury going to pay for that? Well, we have to pay for it through either greater taxes or alternatively issuing more gilts, which seems a very odd thing to do given that that caused the problem in the first place, which on the face of it seems counterproductive. Because what that's going to do is to increase the public sector net debt. More supply, remember, pushes down prices, and when the prices of gilts go down, their yields go up. So what we've entered is essentially a downward spiral and a positive feedback loop. More issuance pushes down prices, which increases the losses, which means that more gilts have to be issued. The Office for Budget Responsibility has issued a forecast of what it expects the government issuance of bonds to be over the years ahead, and it makes a very good point. Now that the Asset Purchase Facility is running down its holdings and selling bonds, the private sector is going to have to buy those bonds, but it's going to have to buy a deluge of those bonds, which make up about 6.5% of UK GDP. And as the OBR says, that's the highest level of issuance we've had this century. Now we can actually see the size of those transfers so far from the Treasury to the Asset Purchase Facility, and you can see how they've been gradually increasing over time. Sanjay Raja, who's a senior economist at Deutsche Bank, estimates that's going to cost around 50 billion for this fiscal year and about 40 billion for next fiscal year. So these costs are mounting, and some of those costs are voluntary. The Bank of England is deciding to sell these bonds at large losses. If instead it chose to sell more of those short-dated bonds, that would reduce the crystallised losses, and cost us less. And this is real money. Remember, the government will not be able to spend money on other things like education and hospitals because of having to bail out this APF facility. So I think the Bank of England's making a huge mistake here and essentially taking money out of the national budget. And that, I think, is a huge mistake. Now, don't forget, if you do want to learn more about investing and things like this quantitative tightening and its effect on bond markets, then you can always join our community. To learn more about that, just go to our website, PensionCraft.com, and remember there's a special discount for members of the Monetary Policy Committee. And, as always, thank you for listening.